But just to give you some background, I've worked in financial services for over 20 years. I started my career in early 2000. And in my many years in the industry, I can tell you one thing for sure: change has been slow. It's been painful. And when it's happened, it's been incremental. But today, I feel quite hopeful. I feel we are at a pivotal point where we will see a huge change in financial services. And which is why I'm excited to be here, because all of us in this room have an opportunity to shape what comes next for us. So let's take our story right to, oh, okay. Sorry, I probably need help. And how do you work? Grant, thank you. Let's take our story to where the tension started, right? Traditional finance versus decentralized finance. And in many ways, unlike probably the description here, this battle is now more of a reality. And we talked about it earlier on. We are seeing intersection between the two worlds, and there's some collaboration, some conflict. But it's important to understand why that exists, right? So centralized finance, or TradFi, is the financial services that I started working in. And that world was very, very different. That world is built on centralized modules. That world is built with a lot of focus on intermediaries, okay? And with very, very dated tech. Now, when I say dated tech, I mean really dated tech. So more than, I would say, 50% of the world's banks still use COBOL. Any guesses how old COBOL is? Yeah? No one? 60 years, okay? So that's a 60-year-old programming language that banks are using, more than half the banks across the world. And it's not a surprise. The last 15 years, banks and financial services organizations have poured billions in trying to modernize their tech architecture. In stark contrast, you have blockchain technologies, which don't have a centralized aspect to it. They're peer-to-peer networks, smart contracts, very modern, right? And with a promise to actually really democratize financial services. But the scale has been untested. But to me, this is not really a technical shift that we see today. It is much bigger than that, because when you change the underlying infrastructure of financial services, there are people involved, there are customers involved, there are regulations involved. And that's why in many ways it feels like a confrontation between what was like the old power and the new power. So if you think about it, DeFi came up with that promise of delivering financial services for everyone. And that was a very, very noble promise. But it didn't quite scale, or the scaling lagged. And there are some key reasons for it. The first important reason behind that is the business model friction. So the initial model of DeFi literally threatened TradFi revenue streams, okay? And which is why it's not surprising that banks and financial institutions were not chasing one another to adopt it, because no one wants their lunch to be eaten. Secondly, there were interoperability gaps. So I talked about the legacy tech. So integrating DeFi protocols in legacy tech is a hair-pulling exercise, okay? And then, very, very importantly, the commercial viability wasn't there. Banks need a commercial ROI. And for that, I mean, it has to impact either side of the P&L. So either the technology advancement will allow them to sell more products and earn more revenues, or it's going to create some sort of cost efficiencies, which means either side of the P&L impacted. And that promise wasn't there. There was no urgency around that. And therefore, there was no adoption, or less adoption. And finally, the UX was poor, right? I think earlier on we talked about it. We talked about how trying to remember from a customer's perspective, trying to remember a 24-word phrase, right? Or fat finger errors because of the immutability, okay? All these are issues, and sort of in some ways, the value proposition did not match up to what I call is the pain-gain ratio. By pain-gain ratio, what I mean is there is a certain amount of pain that both companies and individuals face when they want to adopt a new piece of technology. So to overcome that business inertia, to overcome the tech hurdles, or maybe the poor UX or UI, you need to be able to see the gain, and that gain wasn't evidenced. AI, in contrast, got the red carpet welcome by financial services and individuals. okay? A really, really stark contrast when we think about it. And again, there are a couple of reasons behind it. It is a general purpose technology, okay? So it's not just about changing the financial model, really. And banks saw AI as an enabler, not as a disruptor. So they were more welcoming. The other thing is the ROI, the proven ROI, both sides of the P&L. Okay, it helped banks reduce expenditure and costs. I remember 4 or 5 years ago, name the largest consulting firms. They had very, very glossy decks, which were marched up to boardrooms where it was the promise of saving costs. And much of that has been realized. It's a slow curve, but it's getting there. And the other bit is AI helped hyper-personalization and engage with customers, resulting in better sales. The other bit, which is very striking about AI, is incumbents led the adoption. This wasn't a fringe activity, right? It's not some startup. Yes, startups are there, right? But incumbents led the way. And when large organizations lead the way, they create some sort of legitimacy around it. And finally, fantastic UX. You can't deny that. Natural language is the best programming language out there, right? You don't need to learn a programming language to communicate and get great output. And I want to drive home on that, right? So, and I don't think anyone could say it better than Jensen Huang of NVIDIA, where he said, there is a new programming language and it's called English. And, I want to pause for a second here, what that means in the sense of financial services, okay? So when you look at it, a risk manager or a compliance manager, for instance, can actually just speak to the AI agent in plain, simple English and get some work done. Okay, so for an analyst perspective, it could be like find me patterns in this portfolio. All right, it's a game changer. So I think Huang called AI the biggest sort of invention since assembly line, right? How it's going to change work, and I do believe in that. I think how we work, the way we create output, the way we operationalize is going to change in a big way, and which is why it's no surprise that incumbents were racing to adopt AI. So what have we learned? You've seen DeFi with a great promise to democratize financial services, and AI, which was more general purpose, but because AI promised a P&L return, okay, it promised ROI, it got adopted. And I think the reason for this slide, the reason to talk about this is from financial services perspective, decisions are quite pragmatic, okay? They need to be able to sell this to the boardroom, okay? And if there isn't an urgency and a rationale to show P&L improvement, they can't sell that. So there is no magic adoption, and technology in financial services adoption is never about technology. It is always about return on investment. And I'll tell you why, okay? Yes, financial services is obsessed with profits, but it'll come to life quite soon. And this is really, really a telling slide. So if you look at traditional banks across the world, okay, more than half of them trade below book. And it's monumental if you think about what that actually means. So, before, say, 2008, majority of the banks would trade above book. And when banks are trading below book for such a long time, it really means that investors don't have confidence in it, okay? So after 2008, banks didn't quite recover on their profitability. There are a couple of reasons for that. The regulatory requirement became more and more onerous. Banks had to set aside more capital, okay, which affected the return on equity. The other bit is interest rates, barring the recent interest rates rises that we've seen, had been low for the longest time. So there was never really that recovery that the banking sector saw. And there is another reason for it. Value has been leaving the banking sector hand over fist in the last 15 years. And I can't tell you how important this is in the scheme of things. So just to bring it to life, right? Say if you were in early 2000, and if you were an individual or a financial, or say a small company, you would do mostly all your financial services transactions with your bank. You would open your account there, you would transfer salaries using it, you would pay your vendors through it, you would get a business loan through it. If you had some spare capital, you would use investing arm to invest in it. Today, dial that back, fast forward it, you might use PayPal to do your payments. You might use a peer-to-peer lender to be able to get funding, or another fintech. And if you want to invest something, you might go to a Robinhood, for instance. And if you have some money left, if you do, then maybe you park it with the bank, okay? Now, with every activity that has left the banking sector, what does that mean? That means revenue flying away, interest flying away, okay? And that is continuously happening. And what you see here really is a classic disruption in play, okay? From an individual's perspective or from a company's perspective, if they can get a service which is better, faster, cheaper, they will go to that service. And that's why it's really important when you think about technology adoption to understand the pressure that traditional banks are in and the obsession behind ROI. But then the story takes a surprising turn. And what I mean by it is very, very accidentally, very unintentionally, AI is paving the way for DeFi adoption. And what do I mean by that? In simple terms, I mean that AI is writing the business case for DeFi. So I'll bring it to life, right? So let's look at tokenization, for instance. And I think tokenization is probably one of the most brilliant outputs of DeFi. It's going to help access. It's going to unlock, unlock liquidity for millions of people. So it's a really, really beautiful output of DeFi. And by 2030, the estimates that 16 trillion of real-world assets will be tokenized. Now, that's a massive number when you think about it. Underpinning that tokenization, what do you need? You need automation. You need real-time valuation. You need compliance. And that's where AI comes into play. So AI is going to provide that. So organizations that are leading the way, we heard from Kara before from JP Morgan, or HSBC, even traditional organizations leading the way, they are going to harness the power of AI to be able to scale this. The same holds true for CBDCs, for stablecoins. So essentially, AI will be, think of it as almost like your layer, right? Your governance layer, your security layer, your risk fraud layer, which is going to allow DeFi to thrive. And then, of course, we talked, the previous presentation was about agentic AI and, agents autonomously going and doing chores for you. The same things, the same agentic AI or AI agents will move between TradFi and DeFi seamlessly. So to me, this is actually a beautiful point where the promise of being able to decentralize finance is a possibility because AI will now write its business case and create that ROI, create that P&L positive impact, and which is why we will see a change. So what does that mean in terms of tech stack? Are we seeing that? And I quite like this. I like the slide. I shouldn't be praising my own work, but a few years ago I made this, and I was actually quite proud of myself because I was kind of telling my story into financial services through this. Now, when I started my career in early 2000, the financial services tech stack was two-tier. So you had the rails at the bottom. So think about it, your Swift, London Stock Exchange, Origo, all that good stuff. And then you had product providers, banks writing loans and opening current accounts and investment houses creating investments. And they did some sort of, orchestration, servicing, but it was clunky, let's face it. And we expected very little from banks. At best, we were like, oh, I've got my money back, yay, So the expectation was low, right? And then with intelligent digital services, a new crop, what we call fintechs started coming into play. And a lot of people, I've been around boardrooms for many years now in my corporate career, and they would just call these annoying companies, which will not ever bother them. But all those CEOs were wrong, of course. But what they did is they use the same infrastructure, right? They create intelligent digital services, and they actually created experiences which delighted customers. So it wasn't a hair-pulling exercise to open a bank account, It wasn't difficult. And so they created a level playing field where it said experience can be good. And then, of course, you had the big techs creating the journeys. But what happened, if you think about it, it built over, right, the rails and the products, essentially. And yes, some of the product providers got a bit uncomfortable and said, you know what, maybe we need to up our game, a little bit of FOMO, started innovating there. But what I see now is a change in the rails. Now, I've been in financial services. My father was in financial services. If my grandparents were in financial services, the tech stack would still look the two-tier. In my lifetime, and why I'm really excited to be alive right now, is because this is changing. And we are seeing a change in the rails. So whether it's Ethereum, whether it's Polygon, whether it's Coinbase, which plays across that, or whether it's forcing companies like Swift to start adopting DeFi protocols, or a JP Morgan or a BlackRock can almost change their business model, is not something that we can sit down and say, yeah, that just happened. No, it didn't just happen. It happened because of everyone's hard work. It happened because there is something out there which needs to shift. And when you see rails shifting, that's when it's a pivotal moment and a big change. And finally, and I know Maciej sort of talked about the consumer, for me, I take pride in the work I do. And believe it or not, I took pride in the work that I did even in 2008, okay, when the banking crisis hit, because I still thought what I was doing within the confines of a bank was still trying to deliver good products and services to my customers. So it doesn't matter where you play in, whether you're playing in Rails, whether you're playing in services or you're creating journeys. Ultimately, banking or financial services isn't about a fund. It isn't about banking. It isn't about transferring money. It really is about people trying to navigate through to life, right? It's about managing their, managing difficulties that they face in life, okay, providing them protection for things when it's going to be hard. And it's about them living their full possibilities. So in many ways, to me, okay, banking and financial services is still in that sense a public good. So when you do build something, doesn't matter where, across that tech stack, think about who you're building for, right? And put people in the middle of it. Thank you very much.